you all for joining us. My name is Mary Gardner, and I'm counsel in Venable's DC office. I'm joined today by my partner, Mike Davis, and my colleague, Chris Moran. Mike and I practice in the insurance coverage and dispute group, and Chris is a tax and nonprofit attorney practicing in our Baltimore office. Venable is a multi-practice AM Law 100 law firm with 10 offices and over 850 attorneys within the United States. Venable's insurance coverage and dispute practice is a group of highly skilled attorneys who are committed to helping clients obtain insurance coverage through litigation, mediation, arbitration, and settlement strategies that help our clients win recoveries. We represent insureds across all industries and jurisdictions nationwide in a wide range of matters, including litigation for coverage recovery, policy audits, analysis of corporate insurance programs and risk profiles, and negotiation and drafting of insurance and indemnity provisions in corporate deal documents. Today's webinar is the third in a series of presentations hosted by members of our insurance coverage and disputes practice. Our next presentation is scheduled for July and will focus on entertainment and media insurance issues. In September, we'll have a session focused on cyber insurance. Please stay tuned and watch your email for additional information regarding these programs. Chris, can you go to the next slide? Today, we're going to focus on captive insurance programs. And Mike and I will begin today's presentation with an overview of captive insurance, including potential advantages and mechanisms to evaluate whether a captive may be appropriate for your corporation. And we are thrilled that Chris is joining us to discuss the tax implications of captive insurance as well. Before we get started, please remember that Mike, Chris, and I are not providing legal advice in today's presentation. Our discussion today is rooted in our experiences and expertise from our practice over the past years. And with that, I will turn it over to Mike.
Thanks very much. If we could just go to the next slide. Perfect. So I wanted to give a little overview of what captive insurance is. And when we refer to captive insurance, we actually are referring to an insurance carrier. A captive insurer is a licensed insurance carrier. They're generally regulated under state law. Insurance carriers are generally not regulated much under federal law. Generally, it's a state-by-state regulatory scheme. And as captives have become more popular, many states have sought to encourage captives to domicile within their borders, much as, for example, Delaware does for corporations. We've put up on the slide a few of the states, but there are others as well that are actively seeking to foster the use of captives within their borders. And they have generally enacted laws or regulations to make them captive friendly. Well, if a captive is an insurer, does it have to do the same sorts of things as a commercial insurer, a Chubb or an AIG or a Zurich? And the answer is yes. It has to do those same sorts of things. It writes policies, it underwrites the policies, it handles claims when they come in, and most importantly, it must pay claims if they're covered. However, the difference between a captive and what we might call today a commercial insurer, again, that would be an AIG or a Zurich or someone like that, is that generally it's owned or controlled by those whose risks it insures. So this is somewhat of an oversimplification, but it's generally owned or controlled by the insureds. So, for example, a captive could be formed by a multi-state retailer to provide insurance, say, for the retailer's property insurance in all their different jurisdictions. So if they got hit by a hurricane or if there was a fire, then the captive insurer would respond in a similar manner to a commercial insurer. In some cases, captives are also used to insure more than just the risks of the insureds, but similar entities. So, for example, a trade association could assist in forming a captive to cover its members, even though they're not all owned by the same individuals or parent companies. But all that falls within the general definition of what a captive is. We could go to the next slide, please. So let's talk a little bit about how a captive works. So as I mentioned before, it's an insurance carrier, and so therefore it assumes the risks that are covered by the insurance, and it's responsible to the insureds to pay those amounts, to pay covered claims. As I mentioned before, captive policies are similar to commercial policies, but in my experience, they're often simpler. Because there's a relationship between the parties, usually they don't have quite as many exclusions, they're a little bit less complicated. Generally, they provide more flexibility in terms of what types of law firms might be able to defend claims, for example. Whereas with commercial insurance, maybe you have to be quote unquote panel counsel, if you're familiar with that term, to defend a claim. Usually with a captive, there's more flexibility. So they contain all the normal things that insurance contains. There's an insurance policy. It'll have coverage grants, i.e. what's covered. There'll be exclusions, what isn't covered, and other terms, how notice is provided. They'll have limits. This is the maximum we'll pay. They'll have deductibles, et cetera, et cetera. Now, one of the primary issues with captives, of course, is that they have to pay claims. And so one might wonder, well, is it all or nothing? If I use captive insurance, does that mean that I can't use any commercial insurance or I can't have any risk transfer? And the answer is you can do that. You can risk transfer even if you have a captive. And the way that generally happens, there's some exceptions, but the way that generally happens is by what's called reinsurance. And that's just insurance for an insurer, here the captive. So the captive can buy reinsurance from a reinsurance company, and they could do that at 100%, i.e. all the risk. They could do it at 1%, 1% of the risk, half, however they want. Sometimes captives can also use something called a fronting company. So a fronting company is a licensed insurer, generally a name brand insurance carrier, again, in our example from before, say a Chubb or an AIG or a Zurich. And that insurer issues the insurance policy on behalf of the captive. And then the captive 100% reinsures fronting company. So the fronting company really intends to maintain no risk of loss. And that can be helpful for a variety of reasons. For example, if there's licensure issues or other laws that perhaps the captive can't meet at the state regulatory level, a captive can still be utilized. One issue with that type of structure, of course, is that the fronting company assumes all the credit risk. So if the captive fails for some reason, the fronting company is stuck paying the claims. With that, let me turn it back to Mary for the next few slides.
Thanks, Mike. And then a question we frequently get about captives is what kind of insurance coverage is available through these kind of captive structures? And it turns out there's actually a lot. We frequently see these with respect to workers' compensation claims or employee health care. I think one of the more interesting places that we're seeing captive insurance develop, particularly in wake of the COVID-19 pandemic, is property insurance. Because if any of you have had companies who have tried to submit claims related to your business interruption under your traditional insurance for property coverage, you may be receiving denials of coverage. Running your property insurance through a captive, though, can allow your company to tailor your risk to your specific circumstances and could allow you to provide coverage that's not really going to be commercially available, such as for business interruption related losses to COVID-19. Another that Mike mentioned is the ability to select your own defense counsel, which can be a very valuable tool in third-party policies, such as your product liability or professional liability. Can you go to the next slide? Thank you. Now, there are a lot of different ways that you can structure your captive insurance. And I think the most prevalent today is still the single parent structure. And in that case, it's the captive insurance company is owned by one company, and that company is usually the insured of that captive. The captive itself will generally be a subsidiary of the parent company, and it's most likely going to be structured like a corporation. That means, and we'll talk about this on a later slide, if you're going to set up a single parent captive structure, you have to give a good deal of thought to how you're going to structure your board of directors and your committees, and who would be appropriate to sit on that board, as well as on the committees of the board. Some of the positives of a single parent corporate structure: you have your greatest flexibility. But there's a downside, is that there's a really high formation cost when you're the only party bearing the cost to create the captive. And the kind of trade-off between flexibility and high formation costs means that this type of captive is typically only utilized by large, financially secure organizations that want to have total control over their insurance programs, and are looking for ways also to reap the benefits of the investment income on premiums paid into that insurance structure. Now, that's not to say that single parent captives have to just service the parent company. They can be structured to ensure some third-party risks if desired. The next two types, multi-parent and heterogeneous, are what we generally refer to jointly as group captives. The multi-parent or homogeneous group captive typically covers insureds in the same industry group, whereas the heterogeneous group captive allows a group of insureds from different industry groups to own a captive jointly. Now, generally in the heterogeneous sector, even though the companies aren't within the same industry, they're going to be a relatively similar sizes. And group captives are typically better suited for small to mid-size businesses that have premium volumes that aren't big enough to warrant owning or operating a single parent captive. The benefit is that the members of a group captive will pool together their resources, share their risks, and also share their profits and losses as a result of the captive membership. Typically, there's an application process related to joining a group captive, because it is important to ensure that all member businesses are well run and have risk profiles that will qualify to run with others in a group captive. And it's a way to basically mitigate the risk so that it's lower than what you would find in, the traditional private insurance market. I think probably one of the downsides to group captives are it can be a bit of a management challenge, because you're dealing with a lot of different companies that can have divergent interests. And so again, I think we'll talk about this on the next slide, setting up a board of directors and making sure that all policyholders in your group are adequately represented on that board of directors and by people who have the appropriate corporate governance and financial knowledge is a good way to kind of mitigate some of the management control issues you can have in a group captive. And then a third and fourth type of captive structure is a rental captive or a segregated cell captive. Rental captives are relatively new. They just emerged on the market in probably the last 20 years. And they were really created as a reaction to the cost of forming a single parent captive. And with respect to a rental captive, it kind of works the way the name says that it does. A potential insured goes out, finds an existing captive, and that's often owned by a traditional insurer. And the potential insured creates a separate set of books within its own structure to reflect its like singular risk within its rental structure. The downside of a rental captive is that you're going to be paying increased costs because you're using someone else's captive structure. But generally, it's important to think about those financial risks because they could be offset by not having the cost of establishing and operating your own captive facility. But it's important to know those costs, compare and contrast them, and consider the control and partner. Chris, can you go back? I've got one more thing I wanted to say. So the difference between rental captives and cell captives is that although they're very similar in approach, the segregated cell captive isn't permitted in all domiciles, but it has a structure in which an existing captive assists in creation of cells. And I think the best way to think of it is like a honeycomb. So the captive is the honeycomb, and each of the little cells within the honeycomb is its own captive. So a sponsoring entity sets up and owns the principal company, the honeycomb, and sells or rents cells within that honeycomb to businesses who want to be a part of the captive. In this structure, the sponsoring company will be responsible for the administration, claims, reinsurance placement, and fronting services. So it does come at a cost, but there's no pooling of risk between the cells, and this can create a lot of benefits. It will insulate the assets and liabilities of each of the independent cells. It guards against harmful effects of losses and underwriting by others. You could go to the next slide, Chris. Chris, can you go to the next slide? We seem to be having a few technical difficulties, but the next thing I was going to talk about was when I was putting together this presentation, I had kind of a geeky moment of wondering where the term captive insurance came from in the first place. And I was actually able to find that the term actually dates back to the 1950s to the mining industry. The first ever recorded captive insurance was for Youngstown Sheet and Tube Company for Youngstown's captive mines. And the owner of Youngstown Captive created the Steel Insurance Company of America to write insurance solely for those mines. And so that's where the term captive insurance comes from. But the number of captives has grown astronomically since in the last 50 years. I mean, we're looking at it here in this chart from 100 all the way up to 6,700. And, one thing I believe Mike's going to talk about later is in this really restrictive insurance environment that we're seeing right now, captives are only continuing to grow in popularity, particularly given the vast amount of flexibility that we have to use the different kind of structures that allow for different sizes of companies to participate in captives more than ever before. Chris, can you go to the next slide? And as I've been promising, captives, like all insurers, need to have good corporate governance. Adopting good corporate governance best practices is essential to the long-term success of a captive insurance. And so on top of establishing a board of directors that adequately represents your policyholders and who are qualified to serve on your board of directors, there are 3 really key committees that should be set up in any captive to report to the board of directors so that the board of directors can make sound financial and governance decisions. One is an underwriting committee. This is particularly important outside of the single structure, the single parent captive. So any of the others, you need a group of people that can come together to establish what kind of risks the captive is going to insure, as well as what kind of standards they're going to set for who can participate in each of those risk lines, and the procedures for underwriting potential participants. Similarly, a claims committee is very important. The claims committee should come together to review claims that are being reported to the captive, and that's important to determine your risk trends. Are you seeing a lot of a specific type of claim at once? Are you seeing sufficient reserves established? One issue that we can see frequently in captives is, what if you don't have enough money set aside to pay the claims? It's very important that your claims committee keeps track of those reserve issues. You can work with an outside party called a third-party administrator to handle your claims in exchange for some payment of a fee. That money will come out of the captive's money to do so. So that is an alternative to having the claims committee do all of the heavy lifting itself. And the last, and some would say arguably the most important committee, is your investment committee. And your investment committee is really the first committee you've got to start when you're establishing your captive, because the captive is going to start receiving funds pretty much immediately upon creation. And those funds need to be responsibly invested so that you later have the money available to pay claims. Investments, the earnings can be pretty significant and considerable. So failure to set up an appropriate investment committee with knowledgeable members can really imperil the future of your captive. And Mike, I'll turn it back over to you.
Okay, great. So, captives are not for everyone or for every risk. So we thought we might talk a little bit about what are some of the advantages of captive insurance? Why are they popular? Why do you see a lot of companies utilizing them? One reason, of course, that I'm not going to talk about is tax savings, because Chris is going to devote the whole second half of our program to that. But let me focus on a few others. First is that you can get the coverage you want, even if it might not be available commercially in the marketplace. So a fantastic example is what Mary alluded to before. Let's say you want coverage for business interruption caused by COVID-19 or, whatever might come next. And let's further say that that's really not commercially available in the market. That's something you could do through a captive. You can insure the risks that you want insured. You could have greater control over how claims are handled. Most commercial policies in the United States are what we call duty to defend policies. And that essentially means that the insurer gets to control the defense, subject to certain rules applicable to insurers. They generally get to decide who the lawyers are and make some settlement decisions and other things. And with a captive, since you're controlling the claims, you can do that for yourself. You can also directly access the reinsurance markets that I alluded to before, because you have to be an insurer to access the reinsurance markets, and that can have some cost savings advantages. Sometimes reinsurance can be cheaper than insurance. But remember that regardless of the advantages, one of the primary disadvantages, if you want to put it that way, is that the captive has to pay the claims. So you should strongly consider reinsurance, particularly if the claims are not ones for which you have a solid track record. We could go to the next slide, please. So continuing on with some of the advantages, you can have reduced operating costs, particularly if the risks are well known and quite stable over time, and it's not going to require a tremendous amount of investment to handle claims. You can essentially take the profit that would otherwise go to the insurance carrier. You can accumulate your investment income in the captive, and it can grow over time, again, with certain tax advantages. And you may be able to improve your risk management overall because you can have a central risk pool to aggregate risks among yourself and perhaps subsidiaries or affiliates or similar companies, depending on the type of captive that you choose, as Mary just gave an overview. But of course, with all these advantages comes the responsibility. You still have to pay the claims. You could go to the next slide, please. So in considering whether a captive is right for you, here are some characteristics we've put together. Of course, there are others, but these are some primary ones. Are you paying high insurance premiums with low and consistent claim numbers, such that over time, whether it's 5 years, 10 years, but over some period of time, you're paying more to the insurer than you're getting back? If so, maybe a captive is worth some serious consideration. Do you have steady cash flow? Are you going to have funds to fund the captive, particularly if there's larger losses that are anticipated? Do you have manageable and predictable losses? Do you know what your losses are over the past decade or 2 decades, or perhaps even longer? And have they been fairly steady? Or could you have catastrophic losses in a given year that, if you had to pay them yourselves, could be, painful to pay or perhaps even impossible to pay? And obviously, if you're in the latter category, maybe that's not such a good category for a captive. Some other weaker candidates for captives might be poor risk management practices or high loss ratios, financially less strong, etc. The idea is, are you going to wish you had commercial insurance if there are claims? Because, of course, just setting up and maintaining a captive is no guarantee that claims are not going to come through. They will. And as Chris is going to talk about, one of the things that the IRS and other regulators look at is the captive actually acting like an insurance carrier? And part of acting like an insurance carrier is, of course, paying claims. So with that, Chris, we'll turn it over to you. Or actually, I think, Mary, you have one thing to say, and you can turn it over to Chris. And I'll just remind folks, if they have questions, please feel free to send them through in the message function, and we'll try to address them at the end.
Thanks. And before we turn it over to Chris, today's CLE code is Captive 21. Again, the CLE code is Captive 21. Thank you.
There are some special tax rules for insurance companies that are different than for regular other corporations or businesses. A captive insurance arrangement, it allows the parent insured to self-insure, to deduct insurance premiums it pays the captive, control the investment of the premiums, again, consistent with regulatory requirements for investments, And then when the captive is liquidated, that's usually tax-free to the parent. So if the business winds up, the captive is liquidated. Sometimes there may be substantial funds left in the captive if claims history has been good, and if there's been investment returns, that's usually going to be tax-free to the parent. So insurance companies can deduct a portion of their reserves for unpaid claims, and in addition, insurance companies can typically reduce the recognition of collected but unearned premium income to 20%. So essentially 80% of premiums are deferred. And under a self-insured arrangement, the insured would recognize tax deduction only as losses are paid out over time, but would generally not be able to deduct a reserve for losses. So under a self-insured arrangement, a business would typically set up a reserve to pay out potential losses, but that reserve, even if those funds are really walled off from the rest of the business, they're typically not going to be deductible. So that's one way that in general that a captive insurance company can be beneficial. In addition, insurance companies can be eligible to make special tax elections. So insurance companies with under $2.4 million in annual premium income, and that $2.4 million number is adjusted for inflation. These are often referred to as microcaptive insurance companies. They can elect to be taxed solely on investment income. So none of the premium income would be taxable for a microcaptive. Insurance companies with no more than $600,000 in annual gross receipts can qualify to be tax exempt. I'll discuss this in a little more detail later. Those are typically rare because the $600,000 threshold is pretty rare. And then a captive insurance company that's formed in a foreign jurisdiction can elect to be taxed as a U.S. corporation. So sometimes you see captives formed in foreign jurisdictions because that foreign jurisdiction is favorable rules for captive insurance companies. The regulators in that jurisdiction might have a lot of experience with captive insurance companies. But if there's provisions in the U.S. tax code that impose excise taxes on insurance premiums paid to a foreign insurance corporation, and that the parent insured that's paying premiums to the foreign captive might have a withholding tax obligation. So the code allows the foreign captive insurance company to elect to be taxed as a U.S. corporation, and that eliminates the excise tax and withholding tax burdens. So the term insurance, it's not defined in the Internal Revenue Code, but there's a significant body of case law that is focused on 4 factors. And these are risk shifting, risk distribution, insurance risk, and insurance in the commonly held sense. So risk shifting, that's the transfer of the impact of the potential loss from the insured to the insurer. So that's the standard, probably the core point of insurance is to transfer the risk of loss from the entity, the insured, the entity that's paying for insurance, paying premiums to the insurer. If there's no transfer of risk, then it's not an insurance arrangement. Risk distribution is dispersing risk to a larger population to reduce the chances that a single loss will affect all insured parties in the same manner. So if there's in a single parent captive, there's only one entity that's insured, but it might have, say, very large number of employees that are, and that's sort of how risk can be dispersed across a large population. That's one way. Insurance risk, that's typically implied within the first 2 factors. The core point is that the insured has to face some type of hazard or insurance cannot be present. So, for example, if a parent insured is paying premiums for insurance and it doesn't have any real risk of loss with that issue, or it doesn't face a hazard, then there's no real insurance arrangement. So if you have a doctor in Wichita, Kansas that is paying a lot of insurance premiums for terrorism risk, that doctor in Wichita might not have any real hazard with respect to a terrorism attack. So that might indicate that there's not really insurance risk in that arrangement. Insurance in the commonly held sense, that focuses on whether the insurance arrangement is legitimate. So the captive should be organized and operated as an insurance company, should be licensed as an insurance company, and its primary business should be insurance. So factors that would weigh against this, there would be negative factors could be an overly aggressive investment policy, even if that's permitted in the jurisdiction where the insurance company is, where the captive is incorporated. That might weigh against treatment as an insurance arrangement if the captive is really acting like an aggressive investment company. Another thing that we'll get into a little bit later is whether if the captive is providing financing to the parent, that indicates that the arrangement isn't really insurance, because typically the insurance company is not going to be loaning money to its insureds. There are a few state or federal excise taxes that captive insurance companies might be subject to. Premium taxes owed by the captive insurance company or a licensed fronting company. Self-procurement taxes for insurance companies that independently procure insurance. So I think Florida and California are two examples of jurisdictions that impose an excise tax for insurance companies that that independently procure insurance. Federal excise taxes, which we touched on briefly, if the insurance company is formed in a foreign jurisdiction. Some of these taxes can be mitigated if the insurance company is domiciled in a state that is favorable tax laws. But however, if the captive insurance company is formed in say Delaware and it's insuring a business in Washington State, you can expect that Washington State is going to try to impose its premium taxes or self-procurement taxes on the amounts paid to this captive in Delaware. Generally, the trend has been for other taxes like sales tax and corporate income tax to assign taxing rights based on economic activity. So the tax is imposed where the economic activity is. The case law for insurance taxes maybe hasn't caught up to that level, and there's still some old cases on the books that are still presumably good law that indicate that taxing rights are assigned based on where the captive insurance company is, or the insurance company is domiciled. So there's a little bit of tension there, where states are sometimes more aggressive with imposing taxes based on where the economic activity is or where the insured operates, as opposed to where the insurance company is domiciled. I'll talk a little bit about microcaptive insurance companies. I mentioned it briefly before. Up to $2.4 million in net premium income can be excluded from taxable income. And those premiums are typically going to be deductible by the parent, so that's a pretty significant tax benefit. And because that tax benefit is essentially so significant, there's the potential for abuse, and the IRS has responded to this abuse or perceived abuse by heavily scrutinizing microcaptive insurance companies. So the IRS came out with a notice in November of 2016 that requires all these microcaptive insurance companies and their owners to file IRS Form 8886 to disclose the microcaptive insurance arrangement, unless the company complies with both these safe harbors. So the first is the 70% rule, and it's that the liabilities the microcaptive incurs for paying insurance claims and claim administration expenses are at least 70% of the premiums earned by the microcaptive, less policyholder dividends paid. So if the microcaptive is essentially has expenses equal to at least 70% of the premiums earned, then there's no requirement to file this Form 8886 if it also does not provide financing to the insured or a related party. Providing financing to the insured or a related party, like a loan, that is something the IRS perceives as being abusive because it's a circular flow of funds. The parent pays premiums to the microcaptive insurance company, and the microcaptive loans the money back to the parent. One possible method is to pay out policyholder dividends if the insurance claims and claim administration expenses are less than that 70% threshold. One way to meet the safe harbor is to pay out policyholder dividends. And that the 70% rule is measured over a 5-year period, or however many years the captive has been in existence. So there's sort of a smoothing effect there. And lastly, the ownership of the captive and the insured entities must generally be aligned. So if the persons or entities that own the insured business or businesses are different than those that own the captive insurance company, then the captive insurance is typically not going to be able to make that election to be a microcaptive and to exclude $2.4 million in net premium income. And the IRS has prevailed in several recent tax court cases challenging these microcaptive insurance arrangements. And these tax court wins has sort of emboldened the IRS to really go after these microcaptives. In March and July of 2020, the IRS issued thousands of letters to taxpayers that filed this Form 8886, encouraging the taxpayers to consult with a tax advisor about whether continuing to be in this captive arrangement was sensible, and in some cases even encouraging taxpayers to exit their captive insurance arrangements. The IRS has formed 12 microcaptive examination teams to handle audits of microcaptive insurance arrangements. So there's a significant number of IRS agents that have been trained and are experienced in auditing these microcaptive insurance arrangements. And my experience from the ones I've seen, there's sort of a very cookie cutter approach where the IRS comes in and requests essentially every document you can imagine for involving the captive. And it's pretty burdensome to respond to that request. And then the IRS is going to go in and say, we don't think this arrangement is insurance, and attempt to disallow all the deductions and impose penalties. So again, if a taxpayer does not have a really good business case for setting up this microcaptive insurance company, if the taxpayer doesn't have good facts to show that it satisfies those four factors that indicate the arrangement is truly insurance, then the potential penalties for being in a microcaptive insurance arrangement can be pretty significant. And then lastly, I just want to point out that in December of 2020, the Supreme Court heard oral arguments in a case that challenged this reportable transaction disclosure requirements. So it's possible that in the future, the IRS might need this notice or reporting requirement. The Supreme Court might make a ruling affecting the reporting requirement. Briefly, I'll talk about tax-exempt captive insurance companies. As I mentioned, they're insurance companies that receive no more than $600,000 in gross receipts, and with insurance premiums making up at least 50% of those gross receipts. They're pretty rare. The $600,000 threshold is low, and it can't be avoided by forming multiple related insurance companies because the $600,000 limit applies on an aggregate basis. So if one parent entity forms three separate insurance companies, that the aggregate premiums received by the aggregate receipts and premiums received by those insurance companies are going to be combined in determining whether that $600,000 threshold is surpassed. With that, I'll sort of leave things up for any questions or any other comments.
And Chris, while we wait for Q&A from the attendees, one thing I wanted to ask you about, we were talking about the IRS's initiative to create these micro captive insurance examination teams. Can you talk a little bit about the likelihood of an audit for a captive insurance generally?
Yeah, so that's a great question, Mary. And the risk of an audit is substantially higher with a microcaptive because of that IRS reporting requirement. So every microcaptive, unless it meets those safe harbors, every microcaptive has to file this reportable transaction disclosure with the IRS. So essentially, the arrangement is being served up to the IRS on a platter. So unless these reporting requirements aren't complied with, and there's very, very significant penalties for not complying with the reporting requirements, then the IRS, in theory, knows about every single one of these out there. So that's why the risk is potentially high. Again, that's not to say that these can never be set up properly, and that provision in the code is there for a reason. It's just to say that there needs to be a very good business case for setting up a captive and a micro captive, and a company that does that should be prepared for a potential tax audit.
Thanks, Chris. If there are no other questions from any of our attendees, please know our proverbial doors are open. Please email us if you think of any questions after the fact. I believe that a copy of this recording as well as our PowerPoint slides will be made available. And we did just get a question. Is there a good rule of thumb for the minimum dollar amount of annual premiums for a company before a captive possibly starts making business sense for the company? That's a great question. I think you're talking about minimum premiums. There are some minimum premium numbers. I think, Mike, one of the general premium numbers that I saw was not less than 250,000. I don't know if you've seen anything similarly, a minimum premium amount for a captive to make financial sense.
Yeah, I guess what I would say is it depends to some extent on the tax treatment issues, I think, because if you're talking about small premiums, you're in the micro-captive range. And as Chris was alluding to, there's audit dangers with micro-captives, captives that have very small insurance premiums. Most of the captives that we work on, the premiums are really, much more substantial, and the risks are larger. I don't know, Chris, what you would think, but my impression is that for micro-captives, which would be in the range that Mary indicated, there is a substantial audit risk.
Yeah, that's consistent with with what I see is that if you, in addition, if the premiums are relatively small, then it might not be worthwhile to go through the formation and capitalization costs of setting up a captive. That's not to say that it can't be worthwhile, especially if I've seen instances where a micro captive can make sense when, say, an entity has a really, really good risk management procedures, good claims history, but it's in an industry that is hard to insure, or maybe it's in the same industry and it gets lumped together with a lot of bad actors, and captive insurance, even a micro captive, can really make a lot of sense for those reasons, even if the premiums are not are not really super substantial, because the insurance the company is getting in the market is really not performing well.
Oh, Mike, I think this is a great question for you that just came in. What are your thoughts about traditional insurers being resistant to quoting insurance for companies who have underlying captive insurance?
Yeah, it's a good question, and I think the premise of it is that of course, commercial insurers might view captives as in competition with them, but I really haven't seen that. What I've seen is that reinsurers and insurers are happy to work with captives. I really haven't seen a backlash where they take kind of a punitive position and say, well, we're not going to work with you because you have a captive. And, keep in mind that some very, very large companies have captives that are major buyers of insurance. Some companies that are featured on the front page of the Wall Street Journal, almost every day. So I really haven't seen that. Not to say it couldn't happen, maybe for smaller companies, but that has not been my experience.
Agreed. And then we got a really interesting question about something that you and I both touched on, Mike, which is the use of captives for types of insurance that are difficult to find on the private market. So are we seeing a significant increase in captive insurers being created within the last year as a result of the lack of coverage for future pandemics or additional COVID-19 losses? Or do you anticipate an increase in the number of captives intended to cover this market limitation?
Yeah, that's a good question. The short answer is yes. In the past year, we have seen a number of companies take their property insurance, and property insurance is really where the business interruption risk lives, and put it in a captive. I don't want to use any names because it's confidential, but some very big companies have been doing that. So I do think that's a viable alternative. The problem with it, well, not the problem, but the issue that would have to be addressed, the financial issue, is that if there is another COVID-19 pandemic or something else, the losses would be enormous. So the insurance is only good if the captive has the money to pay them. And because it could be nationwide and it could shut down, a wide swath of industries, just like we've seen, one would have to make sure that they have that substantial risk covered from a financial perspective, because it's great to say that you have insurance, but if you had to pay, if there were another pandemic, you have to make sure it has the actual ability to pay. Otherwise, it's not going to really accomplish anything.
Thank you all for the great questions. I hope you enjoyed our panel today. And as I said, we've put our contact information on this slide. Oh, we've got another one. We do have time. So what industries do you see forming captives most recently? So are we seeing specific industries focused in on the captive space?
This is Mike. I can give you my experience. I've seen a lot of captives in the real estate sector, and others who maybe are not real estate owners, but they part of their business involves large facilities in many different states, and that's consistent with my prior answer, because they're taking their property insurance and moving it. I've also seen companies owned by hedge funds have a big interest in captives. And I think, Chris, I won't speak for you, but I know captives have also been used in the home office space, and perhaps others that you've seen.
You're on mute.
Home office can definitely be one, because a lot of family offices might have unique risks, or they might have unique insurance coverage needs that can't be addressed in the traditional insurance marketplace.
Wonderful. Well, again, thank you all for the great questions. And if you have any other questions, our contact information is on the screen. And I'm sure I speak for both Chris and Mike when I say that we love what we do and we'd love to talk to you more about it. So, and the slides will be made available. So thank you very much. Have a great day.